Global bonds are selling off just as AI earnings and energy shocks pull markets in opposite directions, making cross-asset positioning unusually tricky. Welcome to vTalkInsight, Allocators Lens Daily for May 21st, 2026. Let's start with how this tug of war is reshaping the equity landscape. In equities, the core story is still an AI and semiconductor boom doing the heavy lifting for global indices, while the rest of the market wrestles with higher yields and geopolitical risk. That mix keeps headline performance resilient. But under the surface, the leadership is narrow and the balance of risk increasingly two-sided. NVIDIA remains the emblem of this theme. It has just delivered another outsized quarter, with revenue and earnings well ahead of expectations, guidance pushed higher again, and a massive increase in buyback capacity alongside a dividend boost, all pointing to continued confidence in AI demand. Yet even those strong numbers were followed by a modest share price pullback, reminding us how much optimism is already embedded. Options markets show skew inversion and intense call buying, suggesting many investors are now leaning hard into upside scenarios, which can amplify volatility if anything disappoints. Semiconductor names as a group have reportedly delivered the vast majority of S&P 500 gains this year, with NVIDIA alone contributing a large share of index appreciation. At the same time, concerns are growing about how dependent the broader equity tape has become on a handful of AI winners, echoing past periods where early leaders did not always stay on top once the cycle matured. The fundamental backdrop behind that enthusiasm is powerful. AI infrastructure spending is projected in the trillions annually by the end of the decade. Hyperscaler capital expenditure plans keep being revised higher, and new chip architectures promise big efficiency gains that could further entrench demand. However, the AI supply chain now looks like a potential fault line. Reports of a possible strike at Samsung, shutdowns at advanced memory plants, and already sold-out alternative suppliers highlight how vulnerable high-bandwidth memory and other critical components are to disruption, with knock-on effect for both tech earnings and inflation. Outside the AI complex, earnings season has actually been very solid, with an unusually high share of companies beating estimates and double-digit profit growth on average. Value-oriented retailers and other defensive names are benefiting from consumers trading down, while select cyclicals like transports and home builders are seeing signs of recovery from a low base. Regionally, U.S. benchmarks remain driven by big tech, whereas international markets often look cheaper but continue to suffer from higher energy costs and weaker growth perceptions. Flows still favor U.S. equities, even as European and some emerging markets offer more modest valuations and, in some cases, sectoral exposure that is less tied to the AI narrative. Positioning has shifted from caution to aggressive risk-taking, with record moves by fund managers into equities and heavy upside call activity. At the same time, volatility indices remain relatively subdued even as sector-level swings and post-earnings gaps stay large, which raises the risk of an abrupt adjustment if bond yields lurch higher or an energy shock hits growth expectations. For equity allocators, the key watch points now are the durability of AI-related capex, any escalation in chip supply disruptions, and whether strong earnings breadth can offset pressure from higher long-end yields. That sets the stage for the rates market, where the source of that yield pressure is becoming increasingly central to the cross-asset story. Rates markets are grappling with a pronounced sell-off in global bonds, especially at the long end, as 30-year yields in the U.S. and other major economies push to levels not seen since before the financial crisis. This repricing is tightening financial conditions and challenging the idea that sovereign bonds will reliably cushion risk assets during shocks. The drivers of those higher yields are mixed. Some of the move reflects rising real yields and optimism about nominal growth, but there is also clear concern about persistent inflation, energy-related supply shocks, and widening fiscal deficits, all of which feed into higher term premia. Curves are steepening as investors question how forcefully central banks will lean against these inflation risks. There is notable tension between views that short-dated rates are too high relative to a likely growth slowdown, and market pricing that still embeds additional tightening in some jurisdictions if oil prices and wage pressure stay elevated. Recent data have reinforced that divergence. Softer inflation and labor numbers in the UK prompted traders to scale back expectations for further Bank of England hikes, while the European Central Bank continues to put more weight on the inflation path and on bond market volatility, and the U.S. Federal Reserve appears in no rush to ease despite slowing job creation. At current yield levels, long-dated bonds are starting to attract real money interest from liability-driven investors who may rotate out of tight spread corporates into what they see as more compelling risk-free coupons. At the same time, emerging market fixed income is viewed as offering better carry with limited additional downside, given how much repricing has already occurred. Bond market volatility is elevated, even if it has not yet fully spilled over into equities. If the perceived inflation path shifts again, particularly through energy or geopolitics, another leg higher in yields or a sudden curve flattening could quickly reprice growth stocks and widen credit spreads, so cross-asset investors are watching rate moves very closely. Credit markets, for now, remain more orderly than the rates backdrop might imply. Spreads are tight despite substantial issuance, and recent jumbo deals, such as large multi-tranche raises from high-quality tech names, have been met with heavy oversubscription that underscores still strong demand for corporate paper. A significant share of new financing is linked to AI infrastructure. Data center projects are often pre-leased to investment-grade hyperscalers, which reduces vacancy risk, and some higher-yielding structures in emerging AI names are being engineered to tie credit exposure to those stronger tenants rather than the developers themselves. Even so, several forces argue for more caution. Analysts expect spreads to widen as government and corporate issuance stay heavy, real yields rise, and inflation proves sticky, while there are early signs that long-duration investors are substituting risk-free bonds for tight spread credit at today's yield levels. Another feature is the surge in U.S. corporates borrowing in European currencies to exploit cheaper cross-currency funding, which adds complexity to global credit supply dynamics. Against this backdrop, the key questions for allocators are where compensation is still adequate for late-cycle risk, and how exposed credit portfolios are to a sudden shift in sentiment if bond volatility intensifies. Foreign exchange markets are reflecting many of these macro contrasts. The U.S. dollar remains resilient despite widespread bearish commentary, supported by comparatively strong U.S. growth, robust corporate earnings, and continued capital inflows seeking higher risk-adjusted returns. By contrast, energy-importing economies, especially in parts of the Pacific Rim, are seeing ongoing pressure on their currencies as elevated oil prices erode trade balances. Some countries with large strategic reserves are relatively insulated, but others face a tougher combination of higher import costs, weaker currencies, and tighter policy. Europe sits somewhere in between. Despite local inflation challenges, the region is drawing steady inflows from some Asian investors who view its lower direct hydrocarbon dependence and diversified sector mix as a relative safe haven, even as European equity indices lag U.S. benchmarks. Commodities and energy in particular are the hinge between these stories. Volatility in headline prices has eased a bit, but physical oil markets are tightening as inventories draw down, and there are signs that financial markets may still be underpricing the risk of further supply disruption from the Middle East. Traffic through key choke points, such as the Strait of Hormuz, remains well below normal, and even a rapid de-escalation would likely leave flows constrained for months. NATO involvement in securing shipping lanes is being discussed, but faces political and operational hurdles, which keeps uncertainty high for refiners and end users. Refined products are feeling the strain as well. Shutdowns across a large share of Asian petrochemical capacity, shortages of base oils and additives, and refiners shifting output toward jet fuel all contribute to forecasts of much higher gasoline prices, with obvious implications for consumer spending and inflation expectations. Beyond oil, base resources, and some precious metals are outperforming in pockets of the equity market, reflecting both near-term scarcity and longer-term energy transition needs. Private capital is already moving toward infrastructure and essential services as a way to hedge inflation and benefit from the massive investment required to upgrade global energy systems. The overarching risk is that a sustained energy squeeze feeds a second wave of inflation at the same time that AI-linked growth stays strong, forcing central banks to tolerate higher inflation or tighten more aggressively. Either outcome would have material consequences across bonds, equities, credit, and currencies, so commodity developments remain a central watchpoint for multi-asset allocators. Cross-asset signals today point to an uneasy equilibrium between an AI-powered earnings boom and a world of higher bond yields and fragile energy supplies. Equities still lean on a narrow group of semiconductor and big tech names, even as broader earnings improve, while rates are repricing to a regime of structurally higher term premia and less reliable diversification. Credit remains firm but exposed to heavy issuance and rising real yields. The dollar stays supported by U.S. growth and capital inflows, and commodities, led by oil and refined products, sit at the heart of any second-round inflation shock. For allocators, the key is watching how these pieces interact, whether bond volatility finally spills into equities, whether energy disruptions worsen or ease, and whether AI investment can keep compounding without triggering a sharper policy response. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.